Today, a quick review of the markets. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Today I just want to walk through a few charts and look at the performance of the markets globally and locally. And that includes both the stock markets, bond markets and the futures markets. It's been a wild year, of course, with considerable falls in March and April, but also a considerable bounce after, thanks to all the quantitative easing, lower interest rates, and the sudden positive moves that the market believes to be appropriate. Although I have to say that in absolute terms, the markets are incredibly overvalued and may well correct at some point. The question is when and how. So we'll start in Australia looking at the S&P ASX 100, which was 4.43% down across the year to end at 5,427. And of course, there was a massive drop in March and April, and then a bit of a recovery. And we're seeing that pattern recur across most stocks and most markets. The S&P ASX 200 was down 1.83% to end at 6,587. So our major indices were both lower across the year. That's worth comparing with, for example, the US, as we'll do a little later, which was higher. The financial services index was down 9.86% across the year to end at 5,437. And again, a deep fall between March and May, helped now by significant support from the Reserve Bank. The real estate trusts were down 11.2% across the year to end at 1,442. And this, I think, reflects a lot of vacant commercial property, particularly retail property. And I expect more vacancies ahead, and therefore property trusts are going to underperform ahead as well. Now, the volatility index locally was up 24.7% across the year to end at 1390, but there was a really big peak, of course, in March and April, up nearly 300%. And the S&P ASX 200 futures is at 6,541, which is down 1.68% across the year, and is signalling a further fall when markets open after the weekend. Now, individual financial stocks did perform quite differently. ANZ, for example, was down 8.69% across the year to end at 2270. And once again, we see the fall in March to May, and then the recovery. Remember that all the banks are now being handed considerable support from the RBA. In contrast, CBA is at 8211, up 3.15% across the year. NAB is down 14% at 2260, and Westpac down a massive 21.8% across the year at 1937. Westpac, of course, struggling with some of its cultural and behavioural issues with regard to risk management, and also its significant exposure to the mortgage sector. That said, Bank of Queensland was down 10.42% to 774, and Bendigo and Adelaide Bank was down 10.73% to 932. And Suncorp, the most significant fall this year amongst the regionals, down 26.16% to 974. Of course, all the regionals are struggling with very strong mortgage competition, considerable margin pressure, and also some risk management issues with regard to their portfolios. In comparison, Macquarie Group performed very well, up 2.67% across the year to 138.48. Macquarie, of course, internationally exposed and quite well positioned. The same cannot be said for AMP, which was down 20.2% at 1.56. And I have to say that I can't really work out what the value of AMP is yet, despite the fact they keep selling off bits of their business. Genworth, the mortgage insurer, was down 35.41% to 239. And it's worth saying, I think, that the mortgage insurance sector is going to feel the draft ahead with higher mortgage defaults. But they did also make some adjustments to their capital to support their business. McGrath, the real estate agency, was up 61.02% to 0.475, having languished a lot lower earlier in the year. And that, of course, is based on confidence in the real estate sector. Yellow Brick Road was up 6.25% to 0.085. And mortgage aggregator Australian Financial Group was up 4.32% to 263, having, of course, struggled from March onwards, but now in more positive territory again. And Mortgage Choice was up 5.51% with a similar trajectory to end at 1.435. Afterpay was one of the darlings of the local market, up 287% and ending at $118 flat. And the question, of course, is how high can it go? This, of course, signals a considerable increase in household use of these particular facilities. It's sort of credit without being credit, really. And I think there will be higher prices ahead, but I'm also concerned about the intensity of household debt that this represents. And builders CIMEC were down 25.68% to end at 24.37. Of course, a number of building and construction firms went bust this last year, and we do expect more pressure on the building sector despite all the government support ahead. The Aussie US dollar across the year was up 13.54% to end at 77.05. Now that is a price much higher than the Reserve Bank would like to see. They'd like to see it around 55. But they've also indicated they've got no intention in trying to manipulate the dollar lower. So that means that we're going to be importing deflation, and our costs of goods overseas will be higher, neither of which is necessarily good for central bank policy here. In comparison, the euro Aussie dollar was only down 3.01% to end at 1.5755. The 2-year bond in Australia was down 92.06% to end at 0.063, and you can see the hand of the Reserve Bank here in driving the yield curve lower. The 10-year bond was also down just 12.1% to 0.973. Again, the RBA is responsible for this. And the gold Aussie cross was up 14.07% across the year to 2,457. Gold has done quite well, of course, but it's also true to say that the exchange rate has not helped. And the same is also true of the Bitcoin Aussie cross, which is up 251% to 38,230. So a considerable rise, but also jaded slightly by the exchange rate move. Looking across at the US, the Dow Jones Industrial Average closed up 9.8% across the year to 30,606. So a considerably stronger performance despite the March hiccup. And that's, of course, because in the US, a higher proportion of the market is tech-weighted. The S&P 100 was also higher, up 24.24% to 1,720. And the S&P 500 was up 20.76% to 3,756. The S&P 500 financials was down 1.03% to 490.43, so the financial sector not doing so well. But having said that, Goldman Sachs was up 19.72% to 263.71. And the US Volatility Index was at 84.36% across the year at 22.75, but of course, considerable peak back in March, up more than 400%. And the Nasdaq Composite was up 51.27% across the year to 12,888. just highlights how strong the rise in the tech sector has been. And if we look at some of the individual stocks like Alphabet, Google, up 35.48% to 1,752. Amazon up 86.57% to 3,256. Apple up 102.77% to 132.69. And Facebook up a mere 37.39% to 273.16. In comparison, Boeing dropped 42.35% to 214.06, thanks, of course, to the lack of demand for planes because of the virus and also issues with its new plane as well. GE fell 0.49% across the year to 1080, and Intel was down 13.52%, so not all tech stocks are the same, to end at 49.82. The 30-year US Treasury was down 25.81% to 1.646, so you can see the hand of the Fed. And the 10-year bond was down 48.25% to 0.916, while the 3-month bond was down 95.05% to 0.079. The US dollar index dropped to 89.93, down 8.49%, having been considerably higher earlier in the year. And over in the UK, the FTSE was down 11.54% to 6,460. Now, of course, that may perform differently ahead thanks to Brexit now being fixed or not fixed, depending on your point of view. That said, the financial services index in the UK was up 12.44% to 826.47, though Royal Bank of Scotland, NatWest Group, was down 25.39% to 167.65. And Metro Bank, another UK bank, was down 33.84% to $140, having had a near-death experience quite recently. And the pound US dollar was up 6.55% to 1.3673. Over in Europe, the German 10-year bond was up 59.33 to minus 0.572, but that's a bit of an anomaly really. It's still in negative territory. German 30-year bond was down 231.15% to minus 0.171. Deutsche Bank was up 34.74% to 8.99 following its near-death experience before. And people are a little more confident now about Deutsche Bank, I think, than a couple of years ago. The US dollar yuan was down 6.78% to 6.533, whilst the Shanghai Composite was up 20.37% to 3,473. The gold futures was up 26.85% to 1,901, having of course been a lot higher back in August, but still is reasonably strong. But not as strong as silver, which was up 52.64% across the year to 26.52. And copper was also up 31.74% across the year to 3.52, whilst crude oil was down 16.01% to 48.44, having of course dived back in April and May. Bitcoin was remarkably strong, up 298% across the year, 29,289, and a very strong rise, of course, in the last month or so, as both private investors, small investors, and even larger investors piled into Bitcoin. Question is, will it go higher or will it crash? Nobody knows. The Stock 600 Global Index was down 1.23% to 425. The iShares Russell 2000 EFT was up 23.92% to 196.13. The Euro US dollar was up 9.79% to 1.2134. The Nikkei 225 in Japan was up 18.74% to 27,444. And the S&P 500 futures was up 20.48% to 3,748, whereas the Nasdaq futures was up 55.58% across the year and is currently sitting at 12,883, signalling a pretty flat start to next year. And if you want an illustration of an economy in trouble, the Italian 2-year bond is now sitting at minus 0.472 and is down minus 1,326.32%. A bit meaningless perhaps, but an illustration of what can happen. Now, a few points to make, of course. Firstly, the tech sector has really outperformed everything else, and that's partly because of the lockdowns and the greater use of tech, and also the fact that there is just considerable demand for the underlying technology ahead. Of course, not all tech companies are performing the same. The financial services sector is more varied. There are some doing quite well, Afterpay, of course, doing very well, and other financial services stocks doing less well, particularly here. It's also worth noting the hand of central banks around the world as they create greater liquidity through quantitative easing and drive the yield curve and rates lower. But that necessarily may lead to deflation, not inflation, which is one of those critical things to understand. The liquidity flows are not necessarily going back into the real economy. And that can lead to deflation rather than inflation, which means that they will have to do more. In fact, the central banks often, it seems to me, are pulling in the wrong direction. But many people disagree with me and believe that inflation is coming like in the 1970s, and therefore things like gold is where you should be. Frankly, I'm less sure myself. I think the deflationary pressures will continue for some time and indeed will intensify. There is very little evidence of inflation anywhere. Just look at Japan or the Eurozone. And as a result of that, I do expect negative interest rates to be predominant as we go through the year, both at a wholesale level as central banks start imposing penalties on retail banks if they don't lend, but secondly, translating also to retail deposits, particularly high deposits. And that will force people perhaps to take money out of the banks and put it back into the markets, which is what central banks want. But this is a doom loop, and frankly, there is not much that I can see by way of an exit strategy at the moment, just continuing to pump. That, of course, will have an impact on other assets as well, but may well not hit the real economy. And my final point is this, that the virus and the lockdowns that are nationally and internationally so significant at the moment is the number one issue to watch. If in fact lockdowns continue, if in fact the vaccine rollout doesn't have the desired effect, economies around the world will continue to grind lower. And yet the markets are considerably overvalued, so the question becomes, will there be a correction or will they just shrug it off and go higher? Well, I still am of the view that there will be a correction at some point, but it's not necessarily going to happen immediately because of the central bank interventions. The trouble is, the longer you leave it, the bigger the fall. So I still think there is an argument for a very conservative strategy at the moment, rather than aggressively piling into the markets at these elevated levels. But hey, I could be wrong. It could be that we will see markets continuing to rocket higher thanks to central banks and their market manipulation. And if you conclude that markets are no longer efficient and that they're being considerably skewed by central bank liquidity printing, well then I guess all bets are off. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.